As bottom-up stock pickers, our focus on what we term future quality investments has really helped us in delivering strong and consistent returns over the last few years, even as returns in the market have become more concentrated in a narrower range of stocks, many of which have been in the technology sector. By future quality companies, we mean companies that can benefit from or withstand disruptive change, allowing them to attain and sustain the highest cash flow returns on investment in the market. So when we're researching a business from the bottom up, we're looking for those with a sustainable competitive advantage in the industry they operate in, such that they can earn high cash flows and are able to reinvest those cash flows to sustain or even improve those returns in the future. This selective bottom-up approach means our portfolios are concentrated with around 40 stocks, all focused on future quality investments. A business or industry suffering from disruptive competition is likely to have falling cash flow returns on the investments they're making, so we're unlikely to invest in those areas. So we've successfully, so far, avoided some of these industries such as traditional retail and parts of the media industry. In addition, we've been able to invest in businesses benefiting from these disruptive trends, which have allowed them to earn high returns and successfully maintain their competitive advantage over the long term. Some of these companies have been in the technology sector, particularly those software and service businesses providing the infrastructure for the rollout of cloud and edge computing. Also though, we've found very high return businesses in healthcare, industrial, consumer and financial industries where growth has been good and valuations have been fairly attractive. Essentially, our focus on future quality has allowed us to benefit from investments in some of the growth areas within technology, while also finding high quality businesses in more defensive areas which were relatively undervalued. We'll continue with this focus in our efforts to stay relevant and deliver consistent returns for our clients. As I mentioned before, our strong focus on what we term future quality means this has to be the foundation of our idea generation process. When considering any potential new investment idea, we'll ask ourselves the following question. Can this company attain and sustain cash flow returns on investment amongst the very best in the market over our long-term forecast period? Is the company's competitive advantage and the franchise within the industry it operates strong enough for those high returns to be sustained longer than the market expects? Are company management allocating capital in line with these interests of sustaining or improving returns within the business? And are their incentives aligned with the best interests of our clients? Are there contingent liabilities from an ESG perspective which may be storing up higher costs in the future and may undermine those anticipated high cash flows? Is the business appropriately financed, or is the balance sheet not of sufficient quality? And at the end of it all, does the valuation leave sufficient upside for our clients to benefit from all of this? We have around 400 stocks which broadly meet these criteria, which we monitor as a list of potential future quality ideas. It's our detailed stock and industry level research, along with the engagement with company management, which allows us to bring this down to an active buy list of around 100 fully researched future quality ideas. From this list of 100, we rank these based on their individual upside potential as well as our confidence in the future quality investment case. The 40 stocks with the most upside, which we are most confident in, will make it into the Nikko Shenton Global Opportunities Fund. Firstly, I would point to the considerable amount of academic research which does highlight the benefits of equities for those investors with very long-term time horizons. For those with shorter time horizons, alternative solutions may be more appropriate, and we would just urge investors to make sure their time horizons and risk appetite match up with their individual circumstances. In the short term, equities may be more volatile, but in the long term, their risk-adjusted returns have been quite favourable. Secondly, it's worth noting that a global equity fund does have the benefit of diversification from both a currency and industry point of view relative to more focused single country funds. We also have the benefit of a wide range of potential businesses to invest in, and our focus on the best businesses which can attain and sustain the highest cash flow returns in the market while not taking undue risk from a valuation perspective means we aim to deliver a sustainable and consistent return for our clients relative to the broad global universe of equity opportunities.